today. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Today we're going to go over a couple different questions we've been getting more and more recently from ConocoPhillips employees and kind of how it relates to the pension election, interest rates, how they're changing, and any changes to the pension plan in the future. Now before I get started, I just want to remind everybody that even though the Retirement Group, we've been working with ConocoPhillips employees extensively and retirees, we are not endorsed by nor are we employed by ConocoPhillips. But with that being said, let's go ahead and just remind everybody who the Retirement Group is. First and foremost, again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We do this with a select number of companies. This allows our advisors, myself and others, to get have more of an expertise on your specific benefits plans, whether it be the pension, the 401k, healthcare savings, retirement benefits, things like that. So we can truly hold your hand through that transition process when it comes close to retirement to make sure you avoid a lot of mistakes we've seen in the past and essentially make sure that you maximize all your ConocoPhillips benefits. So whenever you do leave the company, you can start off with the largest nest egg possible. And we do have offices throughout the country, so rest assured, if you still need to sit down with myself or one of the advisors face to face, we can still accommodate that. We've got offices throughout the country. But obviously, these times we can have phone calls, web meetings, email, fax, all that's available as well. At the end of the day, if there's anything you take us up on, if you haven't done so yet, or if it's been over a year or so since we've run it, is to look at our cash flow analysis. I'll circle back to this later, but ultimately the best way to kind of tie everything together to see if you're on the right pace for retirement and also help you determine the different decisions you have in retirement and how it affects you not just now, but in 10, 20, 30 years down the road, is to run that cash flow analysis. That takes about maybe 10 minutes or so of us gathering some data from you, or we can always email you the information, and give us about a week to put that report together. Then it can definitely uncover a lot of information and help you with questions you have as far as that retirement planning transition. So with that being said, let's go ahead and kind of jump into some of these questions. Again, these are not all the questions we continue to get, but we've been getting these a little bit more often recently with all the changes. So if you have any other questions, always give us a call, 1-800-900-5867, and we can dig into your personal situation and help you out with that as well. So the first question we've been getting quite a bit, obviously because of interest rates moving, and you can also go back and reference the ConocoPhillips third and fourth quarter interest rate video that we put out recently to get more detail on this. But so the question, with respect to quarterly interest rates, when do I have to be off payroll to get a lower rate? So again, why this is important right now is the move from third quarter to fourth quarter. The interest rates used have come up a little bit over 1%. So what that means for most individuals, a 1% change in interest rates means about anywhere from 8 to 12% change in your lump sum. So for anybody that, let's say, to keep the math simple, was running a pension calculation for the third quarter and came out to $1 million lump sum, if you decide to wait and retire in the fourth quarter, it's actually going to drop by probably roughly $100,000. So obviously, if you're thinking about retiring in the next year or so, it's really important to review this and make sure that you maximize your benefits, because otherwise if you hang on for another quarter or even a half a year or a full year, you may be working for free or losing quite a bit of money if you're taking that pension lump sum. So the question again, when do you need to be off the books as far as capturing that pension? So right now we're in the third quarter. So again, I mentioned the third quarter, the fourth quarter is going to be a big jump. So in order to actually get third quarter, you need to be have commensurate benefits in the last month of that third quarter. So that's going to be September. So September 1st, because they structure it so that you commensurate benefits on the first of the month. So unfortunately, you don't have that long. You need to be retired by August 31st, so you can commensurate benefits September 1st. If you miss that deadline, you're going into the fourth quarter, and at that point, it may be beneficial to give us a call and monitor rates to see if they continue to move up into the first quarter next year or actually drop. So we'll have to see how those go. So again, you need to be off by September 1st to get the third quarter. Otherwise, you're going into fourth quarter or beyond. Now, another question. We've got a lot of people that have not necessarily been with Conoco or Conoco. Excuse me, did not start with Conoco or Phillips. They were other companies like Dupont, Tosco, things like that, Burlington, where there are some different changes in the pension plan. So this question, I have a few pensions. I have Dupont, Conoco, and ConocoPhillips. How does this work? So again, ultimately, if you've been somebody who's kind of gone through different companies, give us a call. We can run these numbers, show you on the pension calculator how to see how it plays out, because it's a little bit more complicated for you. But in this example, let's say somebody was with DuPont. They may have the pension associated with Dupont, then they transfer it over to Conoco. That may be under the Title One. And then depending upon if they changed over to the cash balance plan with ConocoPhillips, they could actually be in that. So in theory, this person could have 3 different pensions. And so when you run those, there's different parameters for each one. The cash balance plan is a little bit different. When we talked about those interest rates in that prior question, the cash balance plan is not going to be affected the same way that the Title One or Title Four, the Conoco plan or the Phillips plan would be. So that's why, again, it's important to give us a call to kind of run through your specific situation on here. Now, another one, let's say, what is the difference between, I kind of went into this, but what's the difference between Title One and Title Two plan? When I retire, do I get one or both? So let me go back again and remind you what those are. The Title One plan is the Conoco retirement plan. And just like that, the Phillips retirement plan is Title Four. So those are very similar, in which case they're both defined benefit plans with a formula base to determine what your income annuity is going to be for the rest of your life. So what you do is you run the calculation, look at years of service, final average pay, Social Security offset, and the multiplier to determine that we have to give you X, Y, Z, let's say $3,000 a month for the rest of your life. Now, if you want to, you can turn around and take a lump sum on that. That's where those interest rates come into play that we talked about in question 1. Based upon interest rates and your longevity, they'll actually calculate how much of a lump sum they would give you for you to go out there and try and recreate that. Now, the Title II is actually a cash balance plan, which kind of works in the reverse, in which case you're getting credits to the cash balance plan, so you know what your lump sum is year by year, and that's going to grow based upon interest rates. So it's had slow growth historically. Now with these interest rates moving up, we should hopefully see some increased growth in there because it's tied to treasuries. But what's going to happen there is if you want to, instead of taking the lump sum, that cash balance, you can actually take the annuity and you run through a kind of reverse calculation to figure that out. Now, as far as which one do you have, or do you have both, is going to depend upon how long you've been at the company. So if you were either at Conoco or at Phillips prior to the merger, you would have Title I or Title IV. And then you had that choice, actually, when that merger happened, to continue Title I or Title IV, or switch over to the new cash balance plan. So it depends upon what you chose. If you stayed in one of those plans, you only have one. You have Title I or Title IV. If you decide to merge over and switch to the cash balance plan, then yes, you could have 2 different plans. So you've got a calculation on your Title I or Title IV, which provides that annuity or lump sum. Then you've also got your cash balance plan, which gives you that running total and shows you what your lump sum is there. Or you can actually look at taking it as an annuity. Now, there's pros and cons to both, but generally speaking, the lump sum calculation conversion is going to be higher on the Title I or Title IV. The cash balance plan is more portable, and you know what that is day by day. But again, if you have questions, want to review this, the cash flow analysis will be the best way to look at those side by side. And let's see, one more question. This one, hopefully it's not going to be something that comes to fruition, but a lot of people have been asking about, there's a rumor ConocoPhillips is canceling the lump sum option. Can they do that? Well, let me kind of go through a couple different things. Obviously, we don't know the answer as to whether they're going to do it or not, but honestly, it's kind of counterproductive to what most companies are doing right now. A lot of companies are actually trying to buy back pensions and give people lump sums instead of paying the annuity because it's a known variable. They know what they're paying out versus, let's say, if somebody retires, they're 55 and they could live till 90. They don't know how many more years or months they're paying them, so it's kind of an unknown for accounting purposes. It's kind of hard to budget that, whereas if they have a lump sum, they know exactly what they're paying you out when they're getting you off the books, and it's easier for them to calculate that. So I don't necessarily know that we would see them doing away with the lump sum, but again, it can happen, and other companies have done it. But if that is going to happen, keep in mind, it's going to take some time. First, you hear the rumors, then they will actually, usually with pension options, they need at least a year in order to get that pushed through, and sometimes longer. So if this is something that will be happening, ConocoPhillips would actually notify us or notify you ahead of time. And again, since the pension calculation for the lump sum is going to be on a quarterly basis, you should have at least a few quarters ahead of time to determine that. So hopefully they're not going to be doing that, but who knows? But if it happens, it's going to happen slowly. Another concern there might be there is that, I don't think there's any concerns about the solvency of the company, but just so you know, if something were to happen to ConocoPhillips and you had the annuity, then the PBGC steps in to cover that annuity payment up to a limit. So again, that's another question we have from time to time as well. But ultimately, like I said, these 4 questions are kind of some that we've been getting more and more often recently. Obviously, the pension interest rate calculations and that lump sum. So if you have any questions on there, you want to see what your retirement picture looks like, especially if you're thinking about originally retiring in the next year or 2, maybe even 3 or 4 years, we need to run that cash flow analysis. That's where again you take a look at gathering your data as far as what your 401k is, your pension calculation, whether you're looking at the annuity versus the lump sum, any other savings you've had, looking at what your desired retirement spending is going to be, and factor in to figure out, okay, on a conservative level, can you retire now or should you go later, and what those different choices are between the pension and the lump sum versus the annuity, and show you those side by side, how it looks not just now, but in 20, 30 years down the road to really give you the ammo you need to make a decision. But generally speaking, if you're leaning towards a lump sum and you're thinking about going this year or next year, then definitely give us a call, because you may need to retire sooner rather than later to capture more of that lump sum. If you're going to work another 3 or 4 years, then you can stretch that out. But again, it's still worth reviewing once you get within 5 years of retirement. So with that being said, I just want to kind of wrap this up. Again, any questions? A lot of this is somewhat generic, so give us a call directly at 1-800-900-5867. We'll go through your personal situation, let you know where you stand. You can also reach at info@theretirementgroup.com. You can also hold up your cell phone if you want to use one of these QR codes. There's one to schedule a meeting with myself or one of the other number of advisors in our offices across the nation. And that way you can speak with somebody specific about the ConocoPhillips plans. Or there's also one if you want to follow us on LinkedIn and make sure that we send you updated information on the ConocoPhillips specific plans. So you have updates on interest rates and any changes to the potential plan down the road. So with that, I want to wrap it up and thank everybody for spending some time with us today. But again, remind you that even though we've worked extensively with ConocoPhillips employees, we're not endorsed by nor are we employed by ConocoPhillips. But if you want to know where you stand and look at running a review, we can definitely help you out with that. So just give us a call at 1-800-900-5867. Thank you very much, and I hope everybody has a great day.